In this week's update, the reality of commodity cycles. All eyes turned to the US earnings, and precious metals had their chance but finished badly. My name is Garry Davis, and as always, this is general advice only, and please remember to like and subscribe to the video. All right, let's just start with a bit of consideration about what's happening in the commodities market, because we're in a period now where a great deal of wealth can be created from what's unfolding over the next 5 to 10 years in commodities. There is an enormous amount of noise out there from commentators who are all scrambling to make predictions about how good or bad things are going to be, and it can be extremely confusing. And to be honest, there's no real clear-cut set of assumptions that look as though they're you could take them to the bank, because there are so many assumptions that have to be made about future supply and demand, and so many variables depending on which technologies are actually adopted. And that applies pretty much across the whole commodity space, whether it's copper or nickel or lithium or graphite or whatever it might be. And the spread of potential outcomes really is very wide. It can be a third or triple of the midpoint. So these are not minor variations. So what the supply and demand deficit, which looks pretty certain, is going to look like in 2024, 2025 is really up for a huge amount of debate. And as a consequence, what we're going to see is prices moving backwards and forwards as people shift in their assumptions that they tend to embrace. Now, in commodity markets, if you look over the last 100 years, prices tend to move in very large cycles that last anywhere from 5 to 10 years. And these are driven by, the good old underlying supply and demand factors and the commercial reality of what prices mean to manufacturers. And so when prices are high, we tend to get a lot of investment, and that causes a surplus, forces prices down, and then we get a period of underinvestment. And so we cycle backwards and forwards over these big cycles anyway, because that's just how human nature is, how the corporate world works. But it's pretty obvious that when you're standing back and looking at a 100-year chart, that we are in the early stages of an upswing anyway. A commodity upward leg for the next 5 to 10 years is basically due. We're in it, it's started, and it's going to play out for quite some time. But it's being enhanced by a couple of things. We've got the EV revolution, which is akin to the agricultural revolution, the industrial revolution. I mean, this is an amazing wave that, whether you agree with it or not, is basically being demanded by the global population and being mandated by governments, and it's not going to change. So this EV revolution has got huge legs. It's not going to turn down again, and that is just adding on to what was already an upswing in commodity prices. And then we've got the US dollar impact as well. Now, right at the moment, you'd have to say that the US dollar is forming higher highs and higher lows, and therefore it's rising. But how long that gets sustained depends again on a lot of variables, because the major driver of the US dollar direction is really its comparison to what's happening in Europe, because the euro makes up about 50% of that currency basket. And so it's the relativity between what's happening in America and what's happening in Europe. And that's pretty unpredictable at this point in time. So it's very hard to say where the US dollar is going, but right at the moment, the direction would appear to be higher. Now, if we look at some of the individual sectors, lithium prices have moved to new highs above the peak that we saw in 2018, and they're just setting staggering levels, beg your pardon, that were just not on the radar even 12 months ago. So it's quite extraordinary the way that lithium prices have moved. Now, that they will get ahead of themselves and they'll pull back. It's just all part of the cycle. But just use the cycle to advantage. Don't chase prices. Wait until there's a period of relative weakness, which might last a few weeks or might last a few months. But when you know the overall direction is higher, then you can use that weakness to advantage. So we've got demand surging just way beyond expectations. The only drag on lithium prices and the adoption of greater use of electric vehicles is that the semiconductor shortage, which is being caused by supply chain issues, is impacting on how quickly electric vehicles get adopted, because the auto manufacturers just can't get the parts to manufacture at the level that they would like. So that's probably a near term. When I say near term, it might last for anything up to another year. But in the big picture scheme of things, the semiconductor shortage will get resolved. Now, if we look at copper and nickel prices, as I said earlier, there are just so many variables and assumptions here that it's really very difficult to feel confident about the price levels that will be in place in 2, 3, 4, 5 years' time. But I think what we can feel confident about is the direction. So there's going to be significant supply deficits into 2024, 2025, and therefore the prices of the commodities will almost certainly be higher. So I think the direction is not in question, it's just the journey along the way, how volatile it's going to be. But look, that's okay. If you've got a good game plan and you know the direction, then you use that to your advantage. All right, let's turn to the American market. The S&P ended up rising 0.8% for the week, but it finished on a bit of a negative note. The indices were down mildly, and that was because a jobs report came in that was well below what was expected, and that on the surface points to a slowing economy. But look, there's always a lot of variation in these economic data points, and they get revised up and down in subsequent months. So single data points are not that big a deal, really. And how the market responds is also pretty unpredictable. Sometimes we see poor numbers like we saw last night, and the market responds positively because the thinking is that it means that there'll be more stimulus. Other times, the market then worries about a slowing economy means slowing earnings, and so the market reacts negatively. I think it often just happens to be whichever way the algorithms are sort of leaning at the time, which is probably a pretty random situation. So I think this is all just comes down to noise that you probably shouldn't assign too much value to. And the US dollar was flat at 94.1 for the week, and it's really just consolidating a minor breakout that it made about 10 days or so ago. But we've still got a major breakout if it can get above 94.7. So this little consolidation is pretty normal. The 10-year yield continues to inch up, which is what's keeping pressure on growth stocks and on the Nasdaq to a degree, up to 1.61. But again, in the big picture, it's not a high level. And the VIX is now back down below 20. So let's go and look at some charts in the US. So we'll start with the S&P. You can see we've had a correction which from peak to trough was around about 5%. So again, still pretty mild. Didn't manage to make it back to the 200-day moving average. And it's possible that if earnings season is a good one, that we've seen the lows. But as I said last week, I'm still cautious on the short term. And I'd really like to see some substance over the next 2 weeks of US earnings season and to see how the market's going to respond to that. So that's the S&P. If we look at the Nasdaq, pretty much the same pattern. It was down a little bit more last night. Small caps have held up reasonably well, but we're still in this overall sideways pattern. So small caps have done nothing. We had an amazing run in 2020, and I know a lot of members of my services and personally, we did very, very well from US small caps, but that game stopped at the start of this year, and you can just see that in the Russell 2000. So for whatever reason, US small caps not being embraced. The gains are being made in larger cap stocks. Now, if we turn to some of the key spreads, this is the Russell 1000 growth versus value. It's been trending down a bit over the last week, but we're still closer to the top of this very large consolidation that started around about August of last year. We're still closer to the top than we are to the bottom, so it's still in a positive setup. If you look at the small caps, not so much. In fact, we're probably below the midpoint of this consolidation range. It's still positive in the short term, so growth stocks, small cap growth stocks, still doing better than the value stocks, but not to the same degree as the large cap stocks. And if we look at consumer discretionary, so this is probably a more important one in terms of market sentiment. Consumer discretionary is still extremely positive relative to staples. So when you combine that with a VIX that's under 20, there's not much fear in the market at the moment. Now, looking at the currencies, there is the US dollar index. So we had a little breakout of this minor breakout, so above these peaks through here. But the major peak really is here at 94.7 that we've got to go through. So in the short to medium term, higher highs and higher lows with periodic little consolidations. But if it can break above here, then we've got quite a bit of clear air, and we could be looking at the US dollar index back above 100, and that certainly is going to put the clamps on commodity prices. Now, if we just look at the Australian dollar, so we're pretty much reflecting what's happening with the US, and we finished the week at 72.6 on the Australian dollar. Just one other chart that I'll show you, and it's one that I'm watching. It's not really signaling anything dramatic at the moment, other than, so this is HYG. This is basically the junk bond fund. So this is the index that covers bonds of much lower quality, and when that starts to break down, then often that can cause some significant disruptions in the equity market. You can see what happened when we had the COVID crash. We dropped from around the high 80s, and we actually got down as low as 68. A dramatic fall. Now, we haven't been below the 200-day moving average for some time, but we are now. We've just moved below it in the last few days. So this is one that I'm keeping an eye on, and not inconsequential volumes either. So there's certainly a bit of nervousness in the junk bond market, and that is not particularly good news for equities. But not a great deal more to conclude at that stage. The Australian market, 72.6 was where we finished. Our index was up 1.9% for the week, which was a bit of a bounce back from the thrashing that it had received, particularly in the materials sector. And energy remains the driving force, as it is in America. The same in Australia. So that's just the reality of how the market has been going in the US at the moment. So if we turn to, where's the ASX 200? There we are. So quite a positive Friday, which helped the overall result for the week. Materials, nice bounce on Friday, but before that, they'd done absolutely nothing. And this is still a pretty suspect area, I suspect. The iron ore price, pretty unpredictable. Turning now to precious metals. Gold was down just a couple of dollars, but when the jobs report came out on Friday night, there was an initial spike in gold to 1780, went up very, very quickly in the space of 10, 15 minutes. But it couldn't hold it. And within an hour, the prices had rolled over and come back down very sharply and actually ended up falling. So had the chance, but couldn't make it. And there are so many bullish factors. If you just look at the amount of stimulation that's gone into the system in the last decade, it's just extraordinary. It should be very bullish for the gold price, with currencies being devalued in real terms as they are. We've got a number of other factors that should be very positive. We had a jobs report. We've got inflation, which is the outlook for inflation. Despite what the headline numbers say, I think the outlook for inflation is greater than what the numbers are saying. So these should all be good things for gold, and it's continuing to struggle against a background that should be quite positive. So that in itself tells you something. Precious metal stocks, we're still in the same mode as we have been. We're tracing out a series of lower highs and lows. Now, during last week, there was some positive price action, and I thought maybe this could be the turn. But again, on Friday night, stocks failed to indicate that there's going to be any change in the precious metals market. So let's take a look at those charts. I'll just quickly mention Bitcoin. Bitcoin breakout occurred on Wednesday, and we got as high as 55,000 on Bitcoin for those interested in that. Here's the gold price chart on a daily basis. You can see how we spiked up, but basically lost it all. And looking on the weekly, we're still in this downtrending channel. Silver not faring any better, just can't get any buoyancy at all. And when we look at GDX for the stocks, we had a nice little run here, which looked like it was perhaps going to be supportive of the gold price, but really it was just a counter trend rally back to the breakdown, retested the breakdown, and then you can see we gapped above it, but then lost it all and finished back below that level. And the volumes were up a bit as well. So that's normally a fairly bearish sign. That's a failed breakout. And failed breakouts are often lead to more downside than if we hadn't broken out at all, because the breakout draws a lot of short-term speculative traders in. And then once they realise that the breakout has failed, then they'll dump their positions as well. So I wouldn't be surprised if we see the start of a more robust move to the downside. This has been pretty mild so far. Candle range is not very big, bit indecisive, closing off their highs and lows, but this could just be setting up now for something a little bit more significant. Other commodities, copper was up a little bit. I guess it partly about currency. So 420 on copper, nickel back up to 849. But as I said earlier, there's just a huge number of variables and assumptions about future supply and demand, and therefore what the impact will be on underlying metals. But the balance is heavily towards large deficits. I don't think there's too much doubt about the direction. So the long-term outlook is great. There's going to be a great number of mining stocks that are going to do extremely well in this environment. But how you attack it is really more important than the individual, perhaps, stock selection. Now, crude oil still rising, got up to $79. It's a real head scratcher for me, but I'm not trading in that area, so I guess I don't think too much about it. There's the spot copper chart just edging up during the week. Nickel, the same, probably came back from being a bit oversold. So to wrap things up, the US indices and the Australian indices are stuck pretty much, but there are many outstanding buys building. With these price pullbacks, they need to be embraced as opportunities, not something to be fearful about. And the plan that you're adopting is far more important than stock selection. You know, if you've got good stocks and a poor plan, you're probably not going to make any money. If you've got average stocks with a good plan, you're probably going to do really well. So that's just the reality of the market, and it's the thing that, in my experience of 20 years working with traders and investors, it's the one thing that seems the hardest to get people to the table to do. You need to understand your purpose. Is it short-term, long-term? You know, what exactly are you trying to get out of the transaction? What is your time frame? What is your tolerance to volatility? So that going forward, we're going to have significant volatility. Know what your profit taking points look like. And again, this is the most difficult thing that people tell me that they have trouble with. And so there are some simple things that I do, which are contained in training videos. I think they work really well. I think they get you out sooner than most methods, sooner and more reliably. But there are many different methods. You just need to know what your profit-taking exits look like. And the biggest risk to success is us. It's perhaps a lack of a plan and a lack of discipline and allowing emotions to come in at the worst possible time. Portfolio analyst last week, we covered, I think, some pretty good ground. We looked at how to actually get through market corrections and that was really more directed at things that you can do from a psychology point of view, just to make life easier for yourself. There was a new addition to the portfolios, and we also looked at fundamental analysis of mining stocks and all the things that need to be considered. So pretty good session in Portfolio Analyst last week. That's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.